Hi, I'm Donna.
And I'm Ashley. Today we will be teaching about Enron and Worldcom's accounting fraud.
The topics we'll be discussing with Enron are Enron's main products, Enron's accounting fraud and what leads to the scandal, insider information and off-balance sheet risk, Enron's ethics, their fraud and internal controls, Enron and the effect this had on their employees, their consequences, and Arthur Andersen.
Enron was one of the world's leading suppliers of natural gas and electricity. They employed over 21,000 people. Enron was the nation's seventh largest company in spring 2001. Accounting fraud. Soon after Enron experienced a surge of growth in the early 1990s, their problems started to become visible after reinstatement of their financial statements. A reinstatement is when a correction is warranted. Former CEO Lay was in favor of deregulation of energy. Deregulation is when all regulations are removed. Enron used market-to-market accounting, meaning if there are any outstanding balances, Enron can change them to fair market value. Insider trading, illegal destruction of documents, bank fraud, and many other violations occurred within the company. The CEOs wanted to get rich real quick. There was a great amount of collusion among top executives of the firm, and greed played a huge role. Insider information, off-balance sheet risk. Roughly 29 executives at Enron sold their stock at a high value before it drastically dropped. They profited in the millions before any other people knew about the drop. Off-balance sheet entries. For example, Enron would create a power plant, which was an asset, and immediately project its profits before any revenue was made. If the account produced less than projected, Enron would move the account to an off-the-books corporation so the losses couldn't be seen.
With competition, there's always ethics that's going to play a role. And for internal control systems, tone from the top was a big problem with Enron. Skilling introduced one of the toughest performance reviews committees in the nation, and employees got ranked from 1 to 5. The lower the score, the more likely an employee was to be fired. And that's when fraud came into play. Weak internal control systems and independent internal verification systems were flawed from the beginning. Enron did not report debt on their balance sheets. Enron made dozens of partnerships with companies that did not exist to help contain its financial losses, which is very unethical. They had deregulation of energy. And Sharon Watkins was the whistleblower. She was the one who sent CEOs letters warning them of Enron's misleading financial statements. The effect that this had was that Enron encouraged their employees to invest stock in the company, promising there would be a great return value for the years to come. Sadly, this was not the case. Many employees invested their pensions and life savings in Enron stock. When the stocks plummeted, employees lost everything, not only their jobs. Once the company went under, thousands of people lost their jobs, pensions, and savings, totaling to billions of dollars. The effect also had on a stock that was reached in an all-time high of $90 a share and fell to mere pennies.
Consequences. Many executives faced jail time and fines, although some managed to get away. Auditors, management, analysts, creditors, bankers, and regulators all failed to perform their jobs legally and positively enhance the market. Many people lost confidence in the market, and a healthy market needs confidence to thrive.
Arthur Andersen was one of the leading auditors and audited Enron's books and neglected to report the troubling evidence. If correctly reported, Arthur Andersen would have uncovered one of the world's biggest accounting frauds. During this time, a significant amount of other reputable accounting company scandals were brought to light. With auditors, they had trust with their consumers, and because they did not report the problems that they were dealing with Enron, people lost trust in auditors, which took a lot of time to regain.
Sarbanes-Oxley and the SEC. After a great wave of accounting scandals, the government responded with Sarbanes-Oxley at July 2002 with help from the Securities Exchange Commission. These changes were put in place to restore investors' confidence in the market. Investor confidence creates a strong and powerful economy, also to help protect the interests of employees and shareholders. Now on to WorldCom.
For Ashley and Donna, I'm Chloe.
And I'm Sam, and we're going to talk about WorldCom now. Some of the things we're going to talk about with them are their main products, the accounting fraud, the violation of GAAP, who was involved in their violation, what their consequences were, possible explanations for the fraud that happened, Arthur Andersen's with WorldCom, and fraud versus earnings management.
WorldCom was started by Bill Fields in Hattiesburg, Mississippi in 1983 under the name Long Distance Discount Services. It provided long-distance telecommunication services, and in 1985, Bernie Evers became the company's CEO. The company went public in 1989 when it acquired Advantage Companies, Inc., which was a publicly traded long-distance telecom service company. Throughout the 1900s, WorldCom continued to grow by acquiring various companies and expanding operations across the world. WorldCom was charged with securities fraud and conspiracy. $3.3 billion in accounting errors, making the size of the accounting scandal at America's second largest long-distance phone company to more than $7 billion. CFO Scott Sullivan violated the accounting treatment of capital expenditure and the accrual method. Sullivan didn't match revenue with the costs it took to generate the revenue. Sullivan had fraudulently taken billions of dollars in operating expenses and recorded them in the property accounts. This allowed him to remove the operating expenses from the income statement, causing a huge increase in net income and a huge increase in asset.
Okay, so WorldCom's accounts at the time were Arthur Andersen's, who were the same people that looked after Enron's books when their accounting scandal happened, and Andersen's accused Scott Sullivan of withholding information from them, which led to this fraud. So in 2000, WorldCom had a loss of $649 million, but was able to record the profit of $2,608 million because of the way that Scott Sullivan had recorded it. And WorldCom's chief executive, John Skidmore, blamed Scott Sullivan, who was the CFO at the time, and the controller, David Myers, for collusion against the company. And the two were fired, and they were for claiming $3.8 billion in regular expenses as capital investment in 2001. And they were arrested in New York, handcuffed, and paraded in front of TV cameras as part of the Bush administration's crackdown on corporate crime, and both now face 65 years in prison. So fraud versus earnings management. So both involve the intent by reporting management to distort their company's earnings picture by fraudulent accounts does so by violating the GAAP principles, while earnings management does so within the GAAP principles. And so if you're ever looking for a good movie to watch with an educational additive, it basically is about like Enron and the accounting scandals that went on within their company. The movie Wall Street is a really good movie to watch.
Watch it.